Hey folks, this is ACAT with charts for sharkcharts.live, and this is part 2 of my ACAT mini-series. This video is focused on mean reversion moving average, which is the blue band with the lilac mean. When we launched sharkcharts.live, this was the only component of ACAT we had. It does the most obvious thing. It tracks the longest overexpanded period in an adaptive manner. And then as it reverts to the mean, it is designed to reset and start tracking anew. When we launched Shark Charts, the version we had then had fewer features and loaded longer period lengths much slower. So there have been some significant improvements since then just in mean reversion moving average, without even getting to the fact that it's much more useful when you have the compare and contrast with compression MA to go alongside it. For the rest of this video, I've just got a bunch of charts with only the mean reversion moving average bands loaded up. I think it's going to be easiest to walk through just what I'm explaining here and then only start showing how you would compare and contrast and use them together when I've actually introduced both concepts at the same time. So let's just start with what you would get if you loaded just the mean reversion moving average bands on ACAT 14 to 600 standard res onto a BTC USD 4-hour chart. So I haven't picked the easiest chart because there's a lot that's actually going on and it illustrates several points at the same time. And I think that's helpful here because the first mistake I see so many people who get this indicator for the first time or got mean reversion moving average for the first time make is that they see this orange warning color, don't know what it means, and then use it anyway because they're ignoring what it means. What it's saying is that it got to 600 period and it's maxed out. It notices that it likely needs to track higher, but can't. And I've got the high-res 3D wave PM to illustrate what happened here. Yeah, there's just a very large plume here. This is the November drop in BTC USD, and it obviously got way past 600. So you should not use the band if it's got a warning sign. That is the warning that you need to go to either a higher time frame or use the higher period length ACAT. And when we originally released the indicator, there was no way to hide the band, and we had a 14 to 2000 period ACAT. The way we've got it set to weave now works better and loads better for the higher period lengths. And we have in the settings the ability to hide it until tracking resets so that it stitches together nicely with 600 to 2000. Before I do that, there are a couple other points to illustrate here. So first off, you can see the behavior for what actually causes it to reset. It's by default a candle close across the mean, and we'll get into other charts later that show some of the other options you can choose to reset it. But the reason why this is the default is because by far of all the things I have tried on many, many charts, this is the most robust, and it's not that close. For this entire area here, it's not resetting because even though you'll get wicks below the mean, it didn't close a candle, so it didn't reset. So the last thing I want to show on this particular panel is that the V4 Pine script labels, you can learn a lot about the behavior of them just by what's going on here. So by default, I only have the ones for the current tracking shown. Historical labels are in the menu as a different setting. You would turn them on down here, and we'll get into that more in detail as it's necessary and on the detailed mini-series video that goes through this entire menu. So it also makes a point to put the label on the x-axis where it last increased its tracking. So here, the last time it increased its tracked period was when it maxed out. And I've, with the ability to actually pick strings you output out now on V4 PineScript to a label, I can say it's max. And none of the other lesser periods will have that word. So I'm hoping that works as an additional warning. So if you see this, the first thing you should do is say, I either need to go to a higher time frame because it's maxed out, or I need to stitch it together with the 600 to 2000 standard res indicator. So the first thing you would do is set this to hide until tracking resets. Since I've learned a thing or two about making these videos, rather than making you sit through the process where that happens, I've just preloaded what that looks like. Here, I think it's a really good illustration to show you the mostly empty chart about how little of that information was actually relevant. Because this is just a really common mistake, and I really want to drive home that if you see that your indicator is maxed out, use a different time frame or the higher period length one. So now the next step is that we turn on the 600 2000 standard res version, and I have done that helpfully here. I've also gone in and turned on the past labels so that you can see that all the way back here, it was actually 1,730 that it was tracking. It's a good illustration just on the theory behind this, that this is a relative measure of expansion and contraction, because what we're trying to figure out is how volatility is in its cycling behavior, what cycle state it's in, relative to the recent past. And in the late summer to fall of 2018, BTC USD was incredibly compressed. So the first significant move was just a really dramatic overexpansion. And actually, if you go into the details of this entire run, it's actually a series of smaller and smaller expansions underneath the overhead from the larger ones, which is possible even though it's going up in a parabola because it's relative to the recent past. So another major feature we added since inception was that we don't just have the 1.25 standard deviation pivots for mean reversion plottable anymore. We also now have it set to be able to plot up to 3 sets of bands. So I have it set here to show the first set at 1.25, the second set at 2.2, and the third set at 3.2. It is generally the case that if we're tacking a 3.2 standard deviation of the longest overextended period, then we are near exhaustion. It is really hard to spend significant amounts of time at any reasonable period length where you're printing candles much above the 3.2 standard deviation. There's kurtosis in price distributions are not perfectly normal distributions. It's still hard. Where you'll see it most often is an example here where a 1730 LOXP is really much more of a daily expansion as just an expansion from right at the beginning with a sharp move. So you'll often see at the beginning that it starts moving well outside of the higher standard deviation bands. But once it starts just properly trending, we could consider it a high-risk move to counter-trend trade, though where we might suggest doing it is after you've seen a cross back down across this band, especially if you've got additional ways to confirm it, such as CCI rolls on shorter time frames. In general, you just want to be betting trend when you see a strong trend like this and looking for opportunities to buy the dip on a rally like this. But when you're looking for entries to trade counter trend, the place you would want to do it if you're overexpanded like this is all the way out at these further bands. So from here, I want to get into a series of caveats and situations and some of the other ways you can adjust tracking and resetting than just crossing the mean for a reversion. And the first caveat I want to give is a general warning about what happens when you ignore how high a time frame the overexpansion is happening on and whether that is actually tradable information. So US equities have been in a continuous bull market since basically World War II. Really, before the SPX was a proper data set, is when this bull run actually started. After it took almost 26 years for the Dow Jones Industrial Average to recover from its 1929 high and get back to even. But once it happened, this makes historical sense. The U.S. has just more or less kept growing over the years. That's not true of every major world economy. The Japanese Nikkei has set its highs in the late 1980s and has yet to reach out to them again. But we know intuitively that, U.S. equities have been bullish for basically the entire lives of most people still alive. Well, on the monthly chart, what that looks like is a trend. But how would you ever trade this? Generally you would know that on lower time frames you should mostly be bullish most of the time because the overall trend is up over the years. But as far as actually picking entries and exits, we've got as high as the 1290 LOX-P in the financial crisis. And that was literally the first time we have tagged the pivot for mean reversion in 40 years. The band was maybe more useful in the 50s. If you're picking potential places to look for entries every few years. Not that this technology existed at the time, or computers existed at the time in any form that could do this. But for all of this period, really you would say that there's probably even more than a monthly expansion here. Quarterly or yearly is probably, but actually I want to say the yearly on this chart actually overexpands with the 2000 tech boom, but the quarterly is probably closest. It would be really interesting if in the next recession, SPX comes all the way down to probably 1,200, 1,300. I would be very interested in that price area if I ever got to see it. I don't know that I will. When this happened, it was in a global crisis so large and so immense that it was threatening the stability of the financial system, and world economies mostly had to bail out their banks. So it takes a lot to crash a stock market like this. We are in the longest continuous economic expansion as of right now since our entirety of U.S. history. Valuations are historically extremely high. I would not be surprised to see some type of bear market in the next few years, but I would not look at this monthly chart and say, okay, the place I want to definitely set my orders and just sit on them is 1250, because it's hit once in 40 years. And it may be a generational buy, assuming that volatility theory actually applies to this, and this isn't semi-noise, which if the sample size, I really can't be 100% sure that I'm actually right, that you can apply it this easily to equities. But you can make this mistake on other instruments as well. If you pick a time frame that's just way higher than you actually want to trade. If you're looking at BTC USD and you're not looking to hold positions unleveraged for half a year, then you probably don't care that much about weekly trends other than giving you an overall sense of where your bias usually should be. You probably want to be looking at shorter time frames. So for my next set of examples, I've picked out the ETHUSD 15-minute chart and 60-minute chart as of recently. I've tried to align them on some of these tabs I have open to be roughly the same x-axis, because I want to illustrate a couple points with this. First and foremost, they're tracking different lengths, as apparent by the fact that for this entire area, we're retesting the pivot for mean reversion and trialing along it on the 60-minute. But here on the 15-minute, we're actually coming into the band and doing something that it narrows, and you could reasonably call this mean reversion, back test and bounce down off of it. You'll also note that the period that actually gets tracked on the 15-minute is not the same period really in any way that gets tracked on the 60 period, because this is 4 times the length, and LuxP 380 is not 4 times, or is not 1/4 of 710. So there's a couple of things I want to say to explain this to make several different points. And I'll start by just saying, how do you explain, that it doesn't perfectly touch certain things? Here on this band, it gets to in a little bit, but it doesn't really make it all the way. What's actually happening there, and why isn't it working cleanly? And I would say that this is the risk of only looking at one period length. The same region here, if we pull it up on high-res 3D Wave PM, you'll note is actually 4 different plumes have had influence leading onto that area where it kind of moves into the longest overexpanded period area and then rejects down. Being wary of the mistake of just plotting so many lines in a chart that it always looks like it's touching something, it's still the case that volatility is actually expanding and contracting on all periods at all time frames at the same time. And it's just we're trying to pick out the ones that are the most important, and therefore we can pick larger pivots to trade from. But you should be aware that it's not that these different plumes go away and that they have no influence. It's just that we would predict that what they're doing is less important than the longest one. But in the micro chop, as we start to figure out what various pivots do exist and whatnot, it's the volatility and probability distribution cycling on lower things that help give intimate detail as to where exactly price goes. So, and one way to look at this is just say, well, one of these plumes still had some amount of influence and help define a lower period mean reversion here that happened underneath the influence of the higher volatility price action. Another way to illustrate this is to get into one of the first other things you can do to reset prices other than a mean reversion. So if we actually go into what that setting looks like in the menu, and I've just kept the 15-minute charts here up, you have several options. You have reset tracked lock speed after mean reversion, the default option. You also have reset tracked lock speed if it's below the wave PM threshold, which is by default set to 0.7. And you also have reset after just a certain number of bars. Now, if you've been watching Dad Shark's live streams and comments on this strategy, he'll frequently say that when 3D wave PM turns green, which corresponds to wave PM readings below the 0.7 level, it is sufficiently recompressed in order to continue trending. There are drawbacks to using this versus mean reversion, which I'll get to the next couple of panels. But let's see what happens if we look at this based on that criteria instead of an outright mean reversion. So I've set that up on this lower panel here, where now it resets if wave PM gets below the 0.7 threshold. And what you'll notice immediately is that it reset this stuff all the way back here. And that makes sense. We go back to our 3D wave PM. Yeah, it got to 0.7 all the way back here. So in that perspective, arguably this plume wasn't the most important thing going on anymore. In that perspective, it doesn't matter that we didn't cross this mean, and because the overextension that really mattered was this one. This one's a lower period length than this larger one here. So, and at a shorter period length expansion itself hit 0.7 here, so it could start continuing the trend. So what you're seeing is three smaller overexpansions getting to the 0.7 value and no longer having significant trending capability, as opposed to having a combined reading that said it's still all happening underneath the largest overexpanded period. So both perspectives, are compatible with volatility theory. The question is, if you're actually setting up trades, what's more useful? And I'd say it's situational. Generally, it's going to be easier to trade larger time frame trends. And on the 15-minute, we're getting a little bit into the weeds and questionable risk reward in most cases. Though with the amount of volatility in ETH, since it hit its local high of around 360, you arguably would be able to get the risk reward you needed from the 15-minute. But this gives you a way to slice and dice into lower chunks, just a much larger overexpanded period. So I've gone here to illustrate a major pitfall. So recall back on this chart that we had the 600 period it max out here, and we had the 1730 lock speed trigger here, and it really was important all the way over here. Like, we mean reverted to it by the book. We crossed into the bands. We tested around the area. We held a shorter time frame mean as we started trending up. And when we actually had our major pump, the first part of this new trend, or first large increase in the period length of this trend, the first port of call was to mean revert to the longest overexpanded period all the way set back in November. But if we look at that with the 0.7 threshold reset, we get a situation where that too just resets early. And for very long period lengths, even though there is a relevant distribution here, you'll get enough noise at some point as the lower time frames shift around and push the values of really high time frames up and down a little bit, where you'll frequently just trigger the condition and you'll stop tracking. And you'll just completely miss, in a lot of cases, what's going on higher time frames because of that condition. So I would not recommend using the 0.7 value for really high time frames. It's much better for looking at lower period lengths and trying to slice and dice what's happening very locally. Yeah, so another point I wanted to make is if we got another way is if we could try and see another way we could slice and dice this that isn't the 0.7 value, that would give us a lot more to work with than 0.7 did. And for that, this would be a good use of the other option there, which is to just have a hard maximum reset where after a set number of bars, if it's not reaching out to it, it resets. Because that'll avoid the situation where if you're using specifically just the mean reversion MA bands, maybe you don't want to be stuck just having the longest overexpanded period for literally months on the 4-hour time frame, only telling you that we've got this really long-term mean to reach out to. So that, as set to 100 bars, gives you something more like this. And here I've only set the 14 to 600 bands. What you'll note is that the 100 bar reset in general, when there was underneath this very large overexpansion, will give you more tracking for longer. And if you really want to go into the weeds of slicing and dicing timeframes to use specifically longest overexpanded period instead of combining it with compression MA as a more automatic tool to try to make similar observations, underneath a very large overexpansion, using just a set maximum number of bars to reset is a pretty useful option. So, kind of the last point I wanted to make in this video is just to come back to the ETH example and come back to that question where a 380 LOXP is on 15 minute is not similar to 710 LOXP on 60 minute. So what's causing that? And is there something we can do about that? And in fact, there is. What's causing it is this factor here, periods for oscillator lookback. So the way this indicator is calculating what it's doing is it's looking back at volatility over, by default, the past 100 periods. On a 60-minute chart, that would be 400 15-minute periods. So the reason that explains why there's a major LOXP difference between the 60-minute and the 15-minute is just that they're not actually looking back the same amount of time. This is looking back 4 times as much time, and as many bars effectively as the 15-minute. So you can, in fact, adjust that. We generally don't because, frankly, 100 period offers a pretty good balance between reacting quick enough and not getting stuck on hyper-local volatility changes. But if we set this to 25, we instead get this picture where now that we've set the 14 to 600 period to 25, we in fact get basically the same pattern that we had previously. So it's not that there's some great mystery as to why, if you do set ACAT or really any of the volatility-based indicators that we have on shark charts to different time frames, they don't actually track the same period. It's because there's part of the calculation that's tracking a number of bars that's dependent on the time frame. And if you just adjust for the factor, you can lose some precision because 25 1 hour bars is less per data than 100 15-minute bars, but you should get, in almost every case, basically the same picture when you make that adjustment. And part of why I did that on this particular ETHUSD example is because it actually illustrates a way that by tweaking it you could actually get some useful information, where we've more usefully defined this 14 to 600 period band that wasn't at this point still defining overall trend, because with a 100 period look back it was now up to a lock speed of 710. But by having it effectively replicate the 15-minute, it actually gives us much more information for as a target for a local mean reversion. And once that happened, the local downtrend got a lot less harsh. So in combination, the information was more useful. A general theme with ACAT is that it is more useful to compare multiple time frames and look for confluent pivots across several than it is to just look at any one time frame and slice and dice repeatedly and focus on just that time frame. And this is a pretty good illustration of this to close out the part of the mini-series on just mean reversion moving average.